Welcome to this explainer. Today, we're launching a deep dive investigation into the multi-trillion-dollar world of sustainable finance. And we're going to uncover the structural realities behind Wall Street's absolute biggest trend. We're going to look closely at the data, the regulations, and the hidden financial mechanics of ESG, really trying to see if the reality actually matches the marketing.
Think about this for a second. What if the investment you bought to help save the planet is quietly putting your wealth at risk? Over the past decade, billions of dollars have flowed into ESG and sustainable investment funds. Investors were promised something extraordinary, the chance to make money while making the world a better place. But behind the green logos, the sustainability ratings, and all those promises of a cleaner future lies a really difficult question. Are investors buying genuine sustainability, or are they sometimes just paying a premium for a good story?
Part 1. The ESG Investment Promise and the Illusion.
So to understand this illusion, we first have to look at the massive promise that birthed this whole boom. The sheer scale of the capital we're talking about here is staggering. We're looking at an estimated $30 trillion worldwide that relies in some way on ESG information. It was pitched to us as the ultimate win-win for profit and the planet. And you know, we've seen billions flown to these funds because investors genuinely wanted to do good. But here's the catch, and it's a big one. All of this capital and the strategic decisions of 80% of corporate CEOs is built on a single, fairly fragile foundation, ESG ratings.
That brings us to part 2, the data problem, also known as aggregate confusion.
Now this is where things get really interesting. Researchers at MIT uncovered a massive structural problem with these ratings. If you look at traditional credit ratings from agencies like Moody's or S&P, the ratings that tell you how likely a company is to pay back its debt, they have a correlation of 0.92 out of 1.0. Basically, they agree almost all the time. But the researchers found that ESG ratings from the major agencies have a correlation of only 0.54. It's essentially a coin toss. They wildly disagree on what actually makes a company sustainable. So if one agency says a company is this amazing green pioneer, another agency might literally rate it as a terrible ESG offender.
So why on earth do they disagree so much? Well, MIT broke this divergence down into 3 categories. 38% of the confusion comes from scope, which just means agencies are including entirely different things in their ratings. One might look at corporate lobbying, while another completely ignores it. Then 6% comes from weight, how important they think a specific issue is. But check this out. A massive 56% of this confusion comes from measurement divergence. The raters are trying to measure the exact same thing, like labor practices, but they're using entirely different data points to do it. One agency might measure workforce turnover, while another just counts the number of labor lawsuits.
To help explain why this measurement is so noisy, the MIT researchers pointed to something called the rater effect or the halo effect. Think of it like a teacher who just really likes a student overall. You might be absolutely terrible at geography, but because that teacher has a generally positive view of you, they unfairly grade you highly in that subject anyway, just based on their overall perception. Analysts do the exact same thing with corporations. An analyst's overall positive or negative view disproportionately skews how they grade specific, entirely unrelated categories, and that introduces structured, non-random error into the very data that millions of everyday investors are relying on.
Let's move on to part 3, the reality of greenwashing.
So the crucial point is this. If the underlying data is this noisy, what happens when financial firms use it to aggressively market their investment products? We get greenwashing. This happens when the marketing narrative of a financial product severely outpaces the actual reality of how that money is being managed. And listen, this isn't just some theoretical concern. It has recently attracted intense cross-border regulatory enforcement.
Let's track a major real-world example so you can see exactly how this plays out. The DWS asset management scandal. DWS is the massive asset management arm of Deutsche Bank. Back in 2021, their former sustainability chief actually came forward as a whistleblower, alleging the firm was completely misrepresenting how much of its assets were invested using ESG criteria. This literally led to German police raiding their Frankfurt offices in 2022. Ultimately, the US SEC slapped them with a $19 million fine, and just in 2025, the Frankfurt public prosecutor issued a €25 million fine, which is one of the largest of its kind. The prosecutors found that DWS was heavily advertising products as having these great ESG characteristics, even claiming ESG was an integral part of their DNA. But the authorities determined those statements simply did not correspond to reality. The marketing was exuberant, for sure, but the actual implementation just wasn't there.
Part 4.
valuation risks, and the greenium.
All right, let's shift gears from regulatory crackdowns to the actual financial mechanics of your portfolio. When everyone rushes into these funds out of a desire to do good or, honestly, just a fear of missing out, we get what economists call the greenium. This is a premium driven by non-pecuniary demand, meaning people are buying the stock for reasons other than its fundamental financial value. And what does that do? It artificially inflates prices. The basic rule of investing always applies. If you overpay for an asset today, your expected future returns are lowered. You might be buying a genuinely fantastic, sustainable company, but if the market has pushed its valuation to the moon, it could still turn out to be a terrible investment.
The data shows a massive divergence starting right around 2015. This blind enthusiasm is lowering the financing costs for green firms, completely regardless of their actual economic productivity. Meanwhile, it's actively punishing highly productive conventional or brown firms by saddling them with higher financing costs. This wedge, this disconnect between financial valuations and actual productive efficiency, creates a systemic misallocation of capital across the broader economy. And researchers are warning that this could ultimately dampen long-run economic growth for all of us.
Part 5. The Psychology of Green Investing. So you might be wondering, why do everyday investors keep pouring money into a system with so much noise and valuation risk? Well, it comes down to psychology. Researchers found a massive willingness among investors to pay a premium for moral satisfaction. People are willing to pay anywhere from 20 to 63 basis points more in fees just to have an ESG label on their index fund. Yet in reality, ESG mutual funds are actually charging almost 10 to 13 basis points less than regular funds. Now hold on, why would Wall Street charge you less when you've explicitly shown you're completely willing to pay more? The answer is that Wall Street is playing a very, very strategic game here. Creating an ESG fund actually costs the asset manager more in gross fees, right? Because they have to go out and buy all that noisy ESG data we talked about earlier. But they use discretionary fee waivers to artificially lower the cost to you, the investor. They're willingly absorbing the high costs up front and using these cheap ESG funds as loss leaders. They lure you into their ecosystem with a cheap, feel-good green fund, and then boom, they cross-sell you higher-fee conventional products down the line. Furthermore, researchers found that these ESG funds have a 68% stock overlap with non-ESG funds, so you're often buying largely the same large-cap tech and healthcare stocks you would have anyway, they're just wrapped up in a different marketing label.
And that leads us to our final section, Part 6, Who Really Profits from ESG?
We've covered the noisy data, the massive greenwashing fines, and that crazy fee paradox. When we really pull back the curtain on this explainer, we see that the real winners of the ESG boom aren't always the planet, and they certainly aren't always everyday investors. The real winners are the financial intermediaries. Asset managers are using the ESG narrative to gather massive, sticky assets. Rating agencies are quite literally profiting off the aggregate confusion. They're selling multiple conflicting data sets to the exact same institutions. Consultants are making an absolute fortune advising companies on how to navigate these arbitrary ratings. And large-cap tech companies, which entirely dominate these ESG indexes, are receiving artificially cheap capital simply because they don't happen to have heavy manufacturing footprints.
I want to leave you with this final vital thought. Maybe sustainable investing isn't the problem. Maybe blindly trusting the label is. Because in financial markets, a good story can attract billions, but eventually, the numbers have to tell the truth. Thanks for joining me on this explainer, and remember, no matter what you're investing in, always demand the empirical truth.